Hi everyone, in this video we'll be going over A-Level Accounting 2023, May-June Paper 4-1, question number 2. This is the structured paper 4, which consists of 2 questions and each of them will be of 25 marks, and the total time limit given for this paper is 1 hour. So ideally you should be spending about 30 minutes in order to solve each question, and in this video as well we'll be attempting to solve this question under 30 minutes. So without any further delay, let's get started. AD PLC makes one type of product and the demand for which is highly seasonal. The sales manager estimated that demand in the coming months, beginning December, would be as follows. So we can just understand these as our sales units because these are the demands. Then it was the policy of the company to maintain the inventory of finished goods at maximum of 25% of the following month's sales. Sometimes it was not possible for the business to produce enough units in a month, both to meet the demand from customers and maintain the desired level of closing inventory. At these times, the business treated the meeting of demand as more important than maintaining the closing inventory. Okay, so we should prioritize the meeting of demand, which is basically our sales, rather than maintaining the closing inventory at 25%. Regardless, let's figure out the closing inventory, assuming that it's going to be 25% of the sales of next month. So for December, it's just going to be 25% of the sales in January. That is just 6,000 multiplied by 25%, which results in 1,500. For February, that's 8,400 times 25, which results in 2,100 units. For March, that's 12,800 times 25%, which results in 3,200 units. And for April, that's 11,800 times 25%, which results in 2,950 units. And for April, that will be 9,600 multiplied by 25%, which results in 2,400 units. Okay, so this is the ideal closing inventory based on the assumption that it should be at a maximum 25% of the following month's sales. Now, the maximum number of units which could be produced in 1 month was 10,000. So this is our limiting value for production. Now, for the first part of this question, we need to prepare the production budget in units for each of the months from January to April. So for production budget, I'm just going to write down the formula right here. We actually start with our budgeted sales units. Then we subtract our opening finished goods inventory. And then we add the closing finished goods inventory. And we require it for the months from January to April. So that's April, then March, then we have February and January. So like in the format, we first start with our budgeted sales units. Then we need to subtract the opening inventory and add the closing inventory. This will then give our production units. Okay, let's have a look above for our budgeted sales units, which is just the demand given. So that will be 6,000, 8,400, 12,800, and 11,800. Let's write it down. For January, it's 6,000. For February, it was given to be 8,400. For March, it was given to be 12,800. And for April, it was 11,800. Now let's have a look at opening inventory. And remember that the opening inventory for this month is just the closing inventory for the previous month. So for the opening inventory for January, it is just going to be the closing inventory for the month of December. So that's 1,500, 2,100, 3,200, and 2,950. Let's write it down. So that's 1,500, 2,100, 3,200, and 2,950. Now, also remember that the closing inventory for this month is just going to be the opening inventory for the next month. So for the closing inventory of January, it's going to be the same as the opening inventory for February. So that's 2,100, 3,200, 2,950. And for the month of April, we figured it out to be 2400. Okay, now let's figure out the production units. Also remember that we have a limiting criteria. We cannot have more than 10,000 units as our production units. Okay, for the month of January, that is just 6,000 minus 1,500 plus 2,100, which is also in 6,600. So this is within our criteria, so we do not have to change anything. Now for the month of February, that will be 8,400 minus 2,100 plus 3,200, which results in the value of 9,500. Again, this is within our limit of 10,000, so we do not have to change anything. For the month of March, that's 12,800 minus 3,200 plus 2,950, which results in 12,550. So this is in excess of 10,000 units, so we cannot really have this number of units as our production units for the month of March, because the maximum limit is 10,000. Now, in order to make this 10,000, remember that we had another criteria again. At these times, the business treated meeting of demand as more important than maintaining the closing inventory. So we first need to change the closing inventory, and if that's not sufficient, we will then move towards changing the sales units. In this case, so let's figure out the new closing inventory first. So that's 12,800 minus 3,200 plus the closing inventory. This should be equal to 10,000. So the required closing inventory is just going to be 10,000 minus 12,800 plus 3,200, which results in the value of 400. So this will be our closing inventory for the month of March. That's 400. So we need to change the opening inventory for the month of April accordingly. That will be 400 as well. Remember that the criteria said that if changing the closing inventory is not enough, we should change our budgeted sales units. So that just means that while solving this equation, if we got a negative value for closing inventory, because that's not really possible, we cannot produce negative number of units, right? So we need to consider the closing inventory as 0, and then we proceed towards changing our sales units in order to meet our production units. Let's do it for the month of April. That's 11,800 minus 400 plus 2,400. Which results in the total of 13,800. Again, this is not possible. We can only have the maximum production units as 10,000. So the first step would be to change our closing inventory, right? Again, let's write down it in an equation format. So that will be 11,800 minus 400 plus closing inventory. It should be equal to 10,000. Now the closing inventory is just going to be 10,000 minus 11,800 plus 400, which results in the value of negative 1,400. Again, we cannot have negative number of units, so we just consider our closing inventory to be 0 in this case. So if that's 0, we need to check if the equation stands. So 11,800 minus 400 is not actually 10,000. It is 11,400. But we require the total to be 10,000, which means that now we move towards changing our budgeted sales units. So sales units minus 400 plus 0 should be equal to 10,000. And our new budgeted sales units for the month of April should be 10,000 plus 400, which is 10,400. Because we do not have enough produced units as well as the closing inventory in order to sustain this sales units of 11,800. So if we do not have 11,800 units, we cannot really sell those units. We only have a maximum of 10,400 units. Let's write it down. All right, this concludes our production budget as well as the first part of this question. We can now move towards the second one. We now need to explain how the budgeted revenue for the 4 months from January to April should be calculated. So clearly, budgeted revenue is just going to be the product of our demand, which is the number of budgeted sales units, and the selling price, right? But in this case, we have the production constraint, which was the production maximum limit of 10,000. And according to it, our sales for April has now changed. So we need to consider this as well. Let's write it down. The number of sales units which equals the demand times the selling price gives the budgeted revenue but The production constraint must be taken into account for the sales arising in April. Alright, that's all for the second part of this question. We can now move towards the third one. We're given additional information. At present, storage space is limited such that the maximum number of units which can be held in inventory is 3200. Now we need to advise the directors of the company whether or not they should invest in a new larger storage facility. We also need to justify our answer. This is of 7 marks, which means that we need to have at least 6 justifications. So if we have a new larger storage, then this would enable the business to build up their inventory prior to times of expected high demand, because we can create as much inventory as possible and just store it in our new facility, right? Let's write it down. This would enable the business to build up their inventory prior to times of expected high demand. Now also remember that due to the lack of inventory in the month of April, we had to reduce our number of units sold, right? So in such cases, we have a possibility of losing sales because we do not have enough number of units. There is a lack of goods, right? But having a new larger storage facility might mean that we can build up our inventory, which should reduce the possibility of losing those sales because there is no lack of goods now. We can write this down as well. This would reduce the possibility of losing sales because of a lack of goods. And we can relate our present condition to this factor as well, because remember that we changed the closing inventory for the month of March. So if our business had been able to hold more closing inventory in the month of February, then we would not have to lose any sales in the month of April. Let's write it down. If the business had been able to hold more units of inventory at the end of February, then sales would not have been lost in April. But also remember that investing in a new larger storage will have an impact in our cash flows as well. We need to consider that. There would be an impact on cash flow. And this will also increase our storage cost. So this would increase the storage costs. And also remember that higher level of inventory means that there is a higher chance of those goods being damaged, stolen, or becoming obsolete. Let's write it down as well. Higher level of inventory means that there is a higher chance of the goods being damaged, stolen, or obsolete. All right, so we have written down 6 considerations, and based on these, we need to advise the directors of the company whether or not they should invest in a new, larger storage facility. So personally, I would suggest the directors not to invest in a new, larger storage facility, because if our demand falls and then we have a higher level of inventory, it will just result in unnecessary costs. Let's write it down. So the director should not invest in a new, larger storage facility since a lower demand will result in unnecessary costs. Okay, that's all for the third part of this question. We can now move towards the fourth one. We're given additional information. Each unit requires 2 kilos of direct material, and the production manager expects that this material will cost 6 per kilo in January and 7 per kilo thereafter, and no inventory of direct material is kept. Half of the purchases are paid for in the month of purchase, and the remainder are paid for in the following month. We now need to prepare the trade payables budget for each of the months of February and March, and we also need to include the balance of trade payables at the beginning and the end of each month. We need to assume that production is still as in our answer to part A. Okay, so this is for March and February. Now, I'm just going to write down the format for trade payables budget right here. We always start with our opening trade payables. We then add all of our credit purchases and then subtract the cash paid to trade payables, and we also subtract any discount received. And this will be equal to our closing trade payables. So this is the format that we'll be creating here as well. Let's start with our opening trade payables. So what we're told is that half of the purchases are paid for in the month of purchase. So if we're considering the purchase for January, half of it will be paid in January itself, but 50% of it is still yet to be paid. So that 50% will act as the opening trade payables for the month of February. And remember that the cost in January is 6 per kilo and each unit requires 2 kilos. So let's have a look at the production units for the month of January. It's 6,600. Let's figure out its corresponding value. So that will be 6,600 times 2, because each unit requires 2 kilos of direct material, and the per unit rate for our direct material or per kilo rate is 6. This results in the total cost of purchases of raw materials for the month of February to be 79,200. Now out of this, 50% will act as our opening trade payables for February. So that's 79,200 times 50%, which results in the value of 39,600. And this is also the amount that will be paid in the month of February itself. Let's figure out the same thing for March as well. For this, we need to consider the purchases made in February. And the number of units produced in February is 9,500. So let's repeat the same process again. Now for 9,500 units, remember that each unit requires 2 kilos of raw materials or direct materials. And in this case, we are told that the price for the material will be 7 per kilo after the month of January. And since this is for February, we need to charge the rate of 7. This results in the total value for purchases of direct materials for the month of February to be 133,000. And now 50% of it will be paid in the month of February itself, but the remaining 50% will be yet to be paid, right? That will act as our opening inventory for the month of March. And its value is 66,500. Okay, so we're done with the opening. Now let's add the credit purchases made for in that particular month. We are basically told that all of the purchases are in credit because half of it will be paid for in that month and the remainder will be paid for in the following month. So we're not paying when the purchase takes place. So this is not cash purchase. Now we have figured out the total purchases for February to be 133,000. We need to repeat the same process for March as well. For March, the number of units produced were 10,000. So let's calculate it. For 10,000 units, each unit requires 2 and the rate is 7 after the month of January. This results in the total purchases for the month of March to be 140,000. Let's write it down. Okay, we're done with the second item of credit purchases. Now we need to subtract the cash paid to trade payables. So remember that there are two payables. One for the purchases made in this month and one for the purchases made in previous month. So we need to write down both. Let's consider the previous month. So for February, we know that 39,600, which is the opening balance, is basically the purchases made for in the month of January, which should be paid in this month. So this is just paid right now. We need to subtract it. And for March, this will be the 50% of credit purchases made in the month of February. And we have already figured out its 50% to be 66,500, which is basically its opening trade payables. Now let's consider the current month. Half of the current month's credit purchases will be paid for in this particular month. So half of 133,000 will be paid in the month of February itself, which again we have already figured out to be 66,500. And for March, we have our total purchases to be 140,000. We need to figure out its 50%. This results in the value of 70,000. We need to subtract it. Okay, we're done with cash paid. We're not given any information regarding discounts received. So we just assume that there are no discount received in this case. So now we can just figure out our closing trade payables. Let's figure out the total for February. That's 39,600 plus 133,000 minus 39,600 minus 66,500, which results in 66,500. Because the closing trade payables for February should be the opening trade payables for the month of March as well. Now for the closing trade payables for March, that will be 66,500 plus 140,000 minus 66,500 minus 70,000, which again results in 70,000. All right, this concludes the fourth part of this question. We can now move towards the fifth one. We're given additional information. The directors are considering asking the company suppliers to introduce a cash discount of 4% on payments made in the month of purchase. We need to explain how this change would affect the budgeted statement of profit or loss. Okay, so we're basically receiving this cash discount from suppliers. So these will be our discounts received, which means that the budgeted statement of profit or loss should include the discount received as an income. Let's write it down. The budgeted statement of profit or loss would then include an entry for discount received as an income. And since we're treating this as an income, this will definitely increase our budgeted profit, right? And the budgeted profit will actually only be 2%. Because remember that the cash discount is 4% on the payments made in the month of purchase, but we're only paying 50% of the purchases made in that month. So the cash discount we'll be receiving is 4% times 50%, which is basically 2%. Let's write it down. So the budgeted profit would increase by 2% of the purchases Alright, this concludes the fifth part of this question as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.